You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. We are taping Options Playbook Radio right now. It is January 19th. That is a Wednesday. And the markets are closed at this point in time. We did have a little bit of a rough day in the markets. We had the S&P 500 index down 44, trading at 4,532. We had the VIX index spike up 1 point to 2385. And overall, the Dow Jones Industrial Average was down about 340. The NASDAQ was down 166 points. So the weakness was across all markets. And with that said, we're going to feed off of that weakness this week. We're going to actually look at a bear put spread. We haven't talked about a bearish trade in quite some time here on Options Playbook Radio. And a lot of it is because the markets have overall been so strong that it wasn't easy to find bearish trades in general, or if you were looking at bearish trades, there was a ton of volatility and it is hard to come up with just the right strategy. So we're going to actually just look at a good old bear put spread, or a long put spread is another term for it, and we're going to look at it in the S&P 500 index. We're also going to talk a little bit about using it as a hedge. So those are going to be the topics today. But last week, we actually went out and looked at a long straddle in Micron Technology. Symbol was MU. So I'm going to spend a little bit of time talking on the show about that trade, because it's an interesting pricing scenario. And as always on Options Playbook Radio, everything that we talk about is not meant to be a recommendation. We're just here to learn. And whenever I get an opportunity to talk a little bit about pricing on an actual example that we're doing, or a paper trade that we've done for that week, I always like to do that. So the markets have been weak since we talked about Micron Technology last week, and we did a long straddle. So we didn't necessarily care which way the market went, as long as it went in one direction, far distance from where we were at. So we'd like it to go down or up quite a bit. And we did get that type of movement in Micron Technology. So we're up a little bit on the trade, and I want to talk about why I say a little bit. So first, let me go back in preference. Obviously, you can go back to last week's session. You can listen and talk about all the reasons why we decided to do a long straddle overall. But I want to tell you what the trade was. So the underlying stock, Micron Technology, last week was at 95.11. We decided to do a long straddle mainly because of where it was on the chart. Micron Technology was looking to break to an all-time high, going all the way back to the year 2000. Micron Technology had never been that high before. We've had some volatility, just really struggled to break through to that all-time high. And the concept would be, well, either it's going to go back down into the middle of the channel, which was fairly wide, or it was going to break out to the upside, and then who knows where it might go. So we did not have the breakout. So we never did. Well, we actually spent a couple of seconds at a new high in Micron Technology, but we never had the official solid close, a decent amount above the resistance to the upside. So with that said, with the markets being weaker this week overall, the overall market, we see Micron Technology down about $5 since we put on that trade. The stock was at 95.11. Right now, it closed exactly at $90, down $2.87 today. So if you do the math here, that means that put now is 5 points in the money. Now, we went all the way out to the February expiration. We gave this quite a long time to live, and a lot had to do with the fact that we don't plan on being in this trade all the way to February 25th, to the expiration date of February 25th. But if we were going to err, we wanted to err on having too much time than not having enough time. Now, what I'm going to talk about is the detriment to doing that. And there's always a trade-off. One of the biggest trade-offs, if you go out further in time on a long straddle, is the delta situation. Whenever you do a long straddle, you need one of those option contracts to basically take hold of the marketplace and be leading this strategy higher. And that on longer term options is hard for the delta to get momentum. Okay, so what do I mean by that? If you think of delta as we talk about it inside the options playbook, that delta is the probability of an option contract being 1 cent in the money at expiration, right? 1 cent in the money at expiration. So if you think about that and you think about what that means, where is delta going to be the most explosive? And that's going to be closer to the expiration date. And why is that? Well, let's take a situation. Well, we got our stock at 90. Let's say the stock is at 90. We're looking at a 90 strike call option and a 90 strike put up. Well, we'll just say the call option to start with, 90 strike call option. And we have 1 day exactly remaining to expiration. If that is the situation, what would you assume the delta would be? Stock is at 90. The strike is 90. The options are going to expire after tomorrow's trading. What is the delta of that call option? And the answer is 50. It's the most 50 you can get as a delta. As a matter of fact, I don't even need a pricing model to come up with it, because basically if it ticks up, it's in the money. If it ticks down, it's out of the money, and it only has 1 day to live. So if you think about that, and all of a sudden you buy that at the money option contract, and the stock on the open with 1 day to live goes from 90 to 91, it goes up $1. Where do you think your delta would be? Think of it once again. What's the probability of it finishing at least 1 cent in the money? You're not saying the probability of making money. You're saying the probability of it finishing 1 cent in the money. Well, the stock just jumped $1. There's only 1 day of trading left. Now, the probability is pretty high. What do you say, 80, 90? Somewhere in that range? And I would agree with that. So let's say it's 85%. We'll split the difference. So that means that our delta just went from approximately 50% chance to an 85% chance, and means that we're picking up shares of stock, which is basically what delta represents, like each second that market ticks a little bit higher on our call option. It's also true on the put option on the opposite side. So if you're thinking about a long straddle, do you want to have that explosive delta? Well, yeah, I do, without a doubt. I'd love to have that explosive delta. But the downside is In order to get it, I have to go very close to the expiration date. So in this instance, if you want to talk the Greeks, we decided to combat theta, which is time decay, versus getting the advantage of delta and basically gamma, the explosiveness, the rate of change of delta. And so because of that, we're not up that much on the straddle. We're looking good, and I would prefer to have this scenario like we did where we had a precipice, right, where the chart was, and we had the market go down 5 points from when we talked about it. So in general, this is a good thing. And here's how I would play it from here on out. When we went and we put on the trade, we saw that this long straddle was trading for approximately, at the midpoint, about $9.50. Even though we're going out to the February 25th expiration, for $9.50, we could buy an at-the-money call and buy an at-the-money put. Now, if we look at that long straddle, based off of where the market is at right now, down $5 from last week, we see that this is trading at approximately $10. We're up about 50 cents on the straddle. And you say to yourself, well, it moved $5. Why did that happen? Well, that's why I went into the detail about delta before we jumped right into the profit and loss situation, just anticipating the question or the thought overall. So now if I look at that, that means that we are up a little bit, but the dynamics of the trade have changed quite a bit. We now see where the call and the put were both trading for approximately $5. We now see that the put is trading for $7.50. I'm going to go right at the midpoint. That's why I'm kind of questioning it, $7.50. And if I look at the call side, we're looking at about $2.50. Let's make the math simple. So the put is now worth $7.50. The call is worth $2.50. We're at approximately at the midpoint, right around $10. All right. So now that I have a potential gain on the put, remember, we paid $9.50 for this. And I've always said when I'm done a long straddle, I'm okay with legging out of the long straddle. As a matter of fact, I'd prefer to do that. So in this instance, I would go on the put side of this trade, and I would look to try to sell that put for more than $9.50. Now, the magic number, I'm not really sure. Long straddles to me are more of a feel thing in general than they are this as opposed to short spreads where I have a solid set of rules that I want to do time and time again. On a long straddle, you kind of need the home run in order to make them profitable over time. So in this instance, I would probably try to sell the put and put in a good till cancel, sell to close on the put side, right around $11 on that trade. Might go $12 if that makes you feel comfortable. Somewhere where you would be okay with selling that put. That would give you enough profitability for the risk that you put on the trade. That's the first question. And then also allow you to still play the other side of the call. So if that market does go down to the point that the put is trading for $11, the call is still going to be worth something. And depending on where you are to the expiration date, the way the chart is looking, the way things just overall feel in the marketplace, you can either decide to sell the call right along with it, which should bring in some money, or you can go on out and let the call ride and see if you get a whiplash in the marketplace. And Micron Technology, it's trading right now at about a 50% implied volatility. So you may get a whiplash to the upside and the call becomes in the money. But that is the way that I've always approached long straddles. And in this instance, we might have been better off if we would went a little shorter, because we've already got a pretty solid move and got more delta on the put side to try to offset some of the losses on the call side. And so that's always the tough battle with the long straddle, is that if one of your options is making money, the other option is not. So that option that you are positive on has to pick up deltas quickly and has to reward you much more than you are losing on the, at this point in time, out of the money option. In our example, that would have been the call option. Okay. So might want to rewind that go back and go through that scenario once again. But long straddles are probably not a lot of people do them overall, because you do need real big moves and they're usually priced into it. If you're paying for a long straddle and the dollar amount that you're paying usually is fitting for the risk that you are taking. In other words, there's usually not a huge benefit if you're going to be doing a long straddle. So when you do those trades, a lot of people, just as far as pricing is concerned and market makers are concerned, they're always interested in where the long straddle is at. It tells you a lot about the marketplace in general. It's often referred to as the expected move when you look at what the long straddle is trading for. A lot of people will quote it before an earnings report, especially on the short-term expiration that contains the earnings. So it's a very interesting pricing mechanism that is in the marketplace, even though a lot of analysts or pundits really don't talk a lot about long straddles. So I wanted to take that opportunity to go in detail about the delta, to try to let you know exactly why that put option contract is not necessarily rewarding us as much as you might have expected after a 5-point move to the downside. So I'll just finish by this and let you know that the put delta right now is 63. The call on the call side, now there's a little bit of fudge in it. It's about 40. So if you add the put and the call, they should add up to 1. That should be the delta overall. So in more detail, because it's quoted on a per share basis, inside the Ally Invest option chains, we got the put delta on that 95 strike put at 0.63. And on the call side, we have that call delta at 0.358 overall. All right, now that should grow. We get another point down. All of a sudden, we're going to start seeing the put delta go higher and the call delta go lower. And hence, now on that next point movement to the downside, you are getting more profitable on the trade because your put option is working harder for you. All right. So let's get into this week's trade. We're going to look at the S&P 500 index. We're going to kind of broke through a support level on the chart in the S&P 500 index. I think the 200-day moving average has kind of came into play. It's feasible for it to maybe go down towards that level overall. So we're just going to try to feed that momentum and do a very short-term long put trade. Now, this is definitely a speculative trade, so we want to mine our risk. We want to make sure, in my instance, when I'm doing a long put as a speculative trade, I want to try to manage a long put spread. I want to try to manage the risk just by the price that I pay for that trade. So I want to pay less than I want to pay less and have a max risk much lower than the maximum upside potential. Just in case something goes hard against me, I just want to make sure that I have that in place. Now, I can try to manage risk by trading out of it if it goes against me, but I'd prefer to have something that I'm comfortable with as a total risk. And as always on Options Playbook Radio, we just always look at a 1-by-1 spread. We never really try to get into the detail as far as the number of option contracts that we would be trading based off of a portfolio overall. And so we're going to go in and look at the Ally Invest option chains. And we mentioned once again that the S&P 500 index was down 44. It's trading at 4,532.76 to be exact. That's where it closed at today. It is January 19th. It is a Wednesday. We would go out to the 2-day option contract. So we're going to do something where it's very feasible for the SPX to reach that short strike. And we're going to go 10 points wide on our trade. Now, how can we kind of manage our risk reward? If we're going 10 points wide, we're going to go a little bit in the money and then sell a little bit out of the money on our long put spread. So in this instance, we're going to have the January 21st expiration, and these are the option contracts in the SPX that stop trading on January 21st. And in this instance, we're going to go about 10 points wide. Now, if you want to do a speculative trade and you don't want to spend as much as this trade, you can make it a 5-point wide trade and still have that same speculation, but I'm going to manage the risk because I'm going to do a short, not as wide of a long put spread. Okay, so if we use that expiration, they will stop trading on the close on Friday, January 21st. We would be buying the 45.35 put and selling the 45.25 put. That means that we're looking for the S&P 500 index to go from a 45.32 to below 45.25 by the close of the market on Friday, January 1st. Now, the net debit for this trade is $4.35 or $435 plus commission. And that means that if we can fill at the midpoint, it's never a guarantee, but if we can fill at the midpoint, that we have $5.65 worth of upside on that trade. So I have a little bit less risk with a little bit more upside. And if I want to manage that, that means I can go out and look at buying a little bit more in the money, selling a little bit less out of the money. And if I'm straddling the market, this is how I can manage my risk of my long put spread and still stay within a range that I think is very attainable before that expiration date. Now, obviously, if we go way out of the money, we can get it done for cheaper, but that's not really the goal here. We're looking for a small pop, maybe one by Thursday. I would like to be out of the trade if we can get down to our short strike, and then we don't have to worry about all day Friday's trading. That would be my goal overall on this trade if we did this. All right. So, in summary, we are looking at the January 21st weekly expiration in the S&P 500 index. We are going to do a 10-point wide long put spread. We are buying the 45.35 strike, selling the 45.25 strike, doing it for a net debit of $4.35 plus commission. That means on a one-by-one basis, we're looking at $435 plus commission of total risk. And our upside would be $5.65 overall. All right. So how could we use a strategy like this if we have our long stock portfolio and we own a lot of S&P 500 index stocks? A lot of times we can go on out and do a shorter term trade. Just say we're nervous over this week and we're nervous about a 10% move to the downside. So in that instance, if I'm truly using this as insurance, and in the S&P 500 index on a 4,532 point index, if you take that value and you multiply that by 100, you will get $453,000 worth of portfolio value. And that's just from one index option overall. So if I'm trying to hedge a portfolio, maybe a $300,000, $400,000 portfolio, I might go a little bit out of the money, buy one put option, and maybe do it 10 points wide. That would give me some protection if the underlying market moved down over the next week. And that would allow me to stay in the marketplace, be a little bit less nervous about the short term on the marketplace, and provide some protection to my overall portfolio. Now, there's a lot of disclaimers there. That math is not an exact math. It's not an exact science overall if I'm doing it, and it only really works if you do have something that is similar. If your portfolio has a lot of stocks that are contained in the S&P 500 index, but it's a fairly inexpensive way to buy some insurance and just looking for a little bit of protection on the downside, as opposed to buying a put outright overall. So in our instance, our total cost was $435. Just for example, the one option contract that we were buying in this trade is a little bit in the money, but it's the $4,535 put, and that thing is trading for about $32 at the midpoint. So $3,200. So you can greatly reduce your risk by thinking of a spread as opposed to just buying a put option outright. So that was just a little bonus material here on Options Playbook Radio. The official paper trade for the week is going to be a short-term long put spread or bear put spread on this trade. Well, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, send them directly to me at theoptionsguy@invest.ally.com. That's the options with an S guy at invest.ally.com. Please follow me on Twitter. My handle is very simple. It's at my name, at Brian Overby. And thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.